Welcome to EKO201E Economics. I'm Chris Hannum, and this will be the 22nd of 22 lectures, the last on open economy macroeconomics. This is the macroeconomics of international trade and exchange rates. We presented way back in the beginning of this course the idea that trade can make everyone better off, and we presented a simple model, the model of comparative advantage, to explain why economists believe this to be the case. What we're going to talk about here is more details about how those trades do take place in the real economy and what factors can influence them, involving things like world prices of goods, flows of assets instead of goods, and exchange rates. To note first, we always have to begin by defining a couple of important terms in economics, sometimes defining them again. We define an economy as being closed if it does not trade. We define an economy as being open if it does trade. Strictly speaking, if it is completely willing and eager to trade and imposes no restrictions on trade. Now, real economies fall somewhere in between. They're not perfectly, completely open. They usually have some restrictions on movement of goods, movement of people, movement of assets, but they're far from closed. Even the most closed economies in the real world today, such as North Korea, do engage in some trade. Next, to define again those terms, in case you forgot, exports refer to all goods which are produced domestically, produced within this country, and then sold in other countries. Imports for this country refer to all goods that are consumed in this country that were produced in other countries. Net exports, again, is simply exports minus imports, or usually, as it's counted, the value of exports minus the value of imports. And exports, we usually denote NX. What do you think would happen to net exports of the United States specifically if, in the first case, Canada experiences a recession? Now, if there is a recession, this means economic growth is negative or slow. And if we have a recession, incomes tend to fall. Many people tend to become unemployed. So if we have rising unemployment, falling incomes in Canada, an important trading partner with the United States, most important impact for the United States is that the demand for U.S. exports would fall. So U.S. exports would fall, imports may not be affected at all, but U.S. export demand would fall. Net exports, because exports fall, would also fall. In the second case, suppose that consumers in the United States become more patriotic. That is, their tastes and preferences for goods made in the United States, to the extent that there are any goods made in the United States anymore, is increased. What happens to net exports? In this case, we wouldn't expect anything to change with U.S. exports, because American consumers don't demand U.S. exports, but we would say that imports to the United States should fall. Imports would fall because American consumers would switch to an American-made product instead of the foreign product, substituting. So, if exports are constant but imports are falling, net exports should be rising. In other words, the trade balance in the United States should be rising. As our last example, suppose prices of goods produced in Mexico, another important trading partner of the United States, are rising, and they're rising faster than prices for goods that are made in the United States. So relative to American things, Mexican things are becoming more expensive. That means, again, some consumers in the United States might substitute from buying Mexican things, imports, to buying American-made products. It might also be the case that some Mexican consumers might switch to buying American exports instead of buying Mexican products. In both cases, we would expect this to result in an increase in the U.S. net exports, either because imports fall or because exports rise, or both. The other variables, some of those variables we just mentioned that influence net exports for a country. First, preferences. Like we mentioned, this preference for American-made things by patriotic Americans. Those preferences relative for foreign and imported goods can change. When they change, they influence net exports. Relative prices of domestic versus imported goods, they affect net exports. Incomes of consumers at home or incomes of consumers abroad affect net exports, as do exchange rates. Exchange rates act as though relative prices for those goods had changed. Perhaps in Mexico, the price in pesos hadn't increased, but suppose the value of the peso in terms of the dollar had increased, then in dollars it would become more expensive for Americans to buy Mexican goods, and the effect would be the same as if the price in Mexico had risen. Also, transportation costs and government policies can influence net exports as well, sometimes by influencing both exports and imports in the same direction. Over more terms, we said that net exports was synonymous with the trade balance for a country, exports minus imports. If that trade balance is positive, that means exports are high relative to imports, and we call that a trade surplus. It's a surplus concept, just like we might have a surplus of a good in a market. And we call it a trade deficit if that trade balance is negative, so exports are low and imports are high. Now, the United States is one of those countries that has had trade deficits in most years for decades running. Turkey has also had, over the past decade or so, often trade deficits, although Turkey doesn't have this long history of persistent trade deficits like the United States does. And in the most recent quarters, I believe has also had a trade surplus. Now, that specific case, when the value of exports might be exactly equal to the value of imports, so the trade balance was zero, net exports was zero, that's what we call balanced trade. And many of our models use as a simplifying assumption, since net exports must be zero for the entire world. Everything which is an export is an import for somebody. Everything that's an import is an export for somebody. On average, net exports must be zero, so a simplifying assumption in many trade models is that trade will be balanced. For any given country, we would expect that trade ought to be balanced in the long run, usually, even if it's not balanced in the short run. We can also see as an illustration here that as measured as a percentage of GDP, both the United States export share and the United States import share have been steadily increasing over time. So that the United States, as have many other countries over this span, is becoming more open with lower barriers to trade than it had before in the 1960s. It's also the case that the United States and other countries around the world are becoming more integrated, with supply chains spread across the globe. Next, the interactions that different countries have with one another aren't only in goods and services. So if a country has exports, imports, these are flows of goods and services. There are also flows of money, flows of capital, flows of investment. We could have a country which saves and then sends that money overseas where it will be invested in some other country. They may do this by lending money to banks in other countries. They may do this by buying shares of stock for businesses in other countries. They may do this by building factories in those other countries. And all of these we would call capital outflows. Our net capital outflow, or our net foreign investment by our country, is the money that's flowing out of the country minus the money that's flowing in. As we mentioned before, when countries interact in international markets, some of the domestic investment can come from abroad. So we mentioned that in that context. And we mentioned that there are two different types of investment by our citizens in foreign countries, or vice versa, one being foreign direct investment, whereby we build a factory in a foreign country, making a direct investment in that country, and the second being a portfolio investment, when instead of building the factory, We buy shares of a factory which is built by someone else with that revenue. Now, our net capital outflow also measures an imbalance in countries' trade, but now on the monetary side, on the financial side, or on the assets side. When net capital outflow is positive, this means more capital is flowing out than flowing in. Net capital outflow being greater than zero. When net capital outflow is negative, this means that more money is flowing in than flowing out. So if we have a lot of foreign direct investment, we would have negative net capital outflow because of all these capital inflows. Then we can look at the variables that influence not the goods side of international transactions, but the financial and asset side of international transactions, this NCO side. And this would be the interest rates that are paid on assets and investments at home versus investments in some foreign country. If the real interest rate that we could get or other real rate of return on assets that we could get in some foreign country are high, and in our country they're low, we might want to make investments there as opposed to here. Next, if our real interest rate here is reduced, it has the same effect on net capital outflow as an increase in the real interest rate in the foreign country. Also, relative risks. If assets at home are considered to be less risky than assets in that foreign country, that would decrease our desire to invest in that foreign country, reducing net capital outflow. And vice versa. If it's our domestic assets that are perceived as being very risky, as say capital investments in Nigeria, then people in Nigeria might be willing to invest in foreign countries even when the real interest rate in those foreign countries was low relative to the real interest rate or real rate of return in Nigeria. Of course, we can also have effects on NCO that come from government policies, just like we can have effects on net exports. Next, as an accounting identity, all of the transactions that we have in our economy, our international transactions for exports and imports, things like that, they involve money. So our net exports, or just our exports, are something we're exchanging for money. In essence, exchanging for an asset. And to get imports, we're giving some of those assets or some of that money back. So if we have positive net exports, that means we have a lot of money coming into the country. If we have a lot of money coming into that country that we're not spending in that country, that money must flow back to the original country, directly or indirectly, so that they have the money with which they can buy our net exports. So as an accounting identity, a country with positive net exports must also have the same positive net capital outflow. If Germany has positive net exports, Germany must be sending money out to the rest of the world so that the rest of the world can be able to pay for German assets. And as we think of these as transactions that occur in asset markets, we know that a foreigner who's buying a German thing is paying with a foreign asset. So the Germans, as they export more, acquire more foreign assets, which is a net capital outflow. Even if nothing is actually moving in that direction, they've simply obtained bonds, they've obtained stocks, or they've literally obtained currency. Now also, we looked at this accounting identity back in our early chapter on macroeconomics, and we said that as an accounting identity for a nation, Y had to be equal to C plus I plus G plus NX as an identity. It had to be because that's how we defined Y. These are just the different components that make up Y. So if that's the case, it must also be the case that Y minus C minus G was equal to I plus NX. We used that to describe how saving had to be equal to investment if NX was 0. So if saving is equal to I plus NX, then if NX is positive, then savings is greater than investment. We're saving a lot, but not all of that money is being used for investment in our country. Some of that money is being sent to other countries and invested there. On the other hand, if we have a negative net exports because imports are larger than exports, in that case, we have money flowing into the country and we're able to invest more than we saved. As an example, or as a case study, you can look at the U.S. trade deficit. And we said that the U.S. has a negative trade balance or trade deficit, and it has every year for decades. Reached record levels in 2006. Now, if we say that net exports has to equal net capital outflows, which has to equal S minus I, what that means in a special case of the United States is that the United States has every year for decades been saving little and investing a lot. And it's been able to do this because of all of this money coming into the country from a negative net capital outflow by investors in foreign countries. And we can see on this table with the U.S. saving and investment and net capital outflow over these decades from 1950 to 2012 that there was a period at the beginning of that graph in the 1950s and 1960s when saving and investment in the United States were pretty much the same. Saving investment in the United States didn't begin to diverge really until the late 1970s. But once they diverge, they continue to stay ever farther apart, as saving in the United States remained lower than investment. And also in the United States, firms were able to invest even though the United States was not saving enough. So what has led to this phenomenon in the United States, where the United States is not saving as much as the United States is investing year after year after year? Is it because people in the United States don't export enough or don't want foreign goods too much? Not necessarily. So much of the reason for this in the United States, particularly in the 1980s, in the early 2000s, and again in the most recent years, which don't show up on that graph, in the Trump years, the US government has a huge budget deficit. This means that in the United States, G is very high relative to T, and public saving is very strongly negative. When public saving is so negative, it may be the case that private saving is sufficient to cover investment, but so much of private saving is taken away by the need to lend to the government that total saving, national saving, is not sufficient to meet national investment. And this is the big reason over this entire span of time, while the United States structurally has had negative net capital outflows and negative net exports. We'll also see in the 1990s, government budget deficits were shrinking. They were as low as they have been, and there was one brief period at the end of the Clinton years when the United States government saw surpluses, and they were debating what to do with these government budget surpluses. We saw at that time, when those government budget deficits shrank, we also saw that the trade deficit in the United States was reduced as well. Well, it's an open question to economists, to macroeconomists at least, how bad it is that the United States has these high government budget deficits. Therefore, the U.S. has these big trade deficits. On the one hand, this means that the United States is selling off a lot of assets over time to foreigners, or they're borrowing money from foreigners, because that's in effect giving a bond or a loan, an asset to foreign banks or other foreign investors. However, the United States is also able to make investments because of these capital inflows and trade deficits that they would not have otherwise been able to make. And those investments may yield returns. If those investments give a higher return than the amount that the United States will ultimately need to pay for these debts to foreigners, this could still wind up being beneficial to the United States in the long run, as compared to a different scenario in which government budget deficits were still high, so national saving was still low, but there was no ability to borrow from abroad in order to keep investment high. Next, we also want to describe a term, a concept in economics that we call a nominal exchange rate. This is a nominal variable, or intended to be something that represents a nominal variable, just like we talked about nominal interest rates, nominal wages, etc. A nominal exchange rate is the rate at which one country's currency is exchanged for another. A real exchange rate would be an exchange rate that, unlike the nominal exchange rate, corrects for differences in prices and differences in inflation between those countries. Now, what we'll do is we'll express all exchange rates as foreign currency per unit of US currency, for simplicity's sake. And show some examples from 2014. The Canadian dollar, you could buy 1.12 Canadian dollars with a single US dollar. You could buy 0.73 euros at that time with one US dollar. You could buy 13.41 Mexican pesos with $1, or you could buy 102.34 Japanese yen with $1. Those are nominal exchange rates, or they were nominal exchange rates as of January 29, 2014. Those are, of course, not real exchange rates. We'll get into in a bit how to calculate a real one. Now, people often naturally assume that if a country has a high exchange rate, as in you can't buy very many dollars with a single yen, you can buy a lot of yen with a single dollar, that should mean that necessarily the yen is a weak currency and the dollar is strong. But that isn't really the best way to think about it. It could be that the Japanese yen is able to buy more dollars than it could have a year before. Perhaps the year before, it was 105 yen to the dollar. Now it's 102.3. We wouldn't describe in either case the yen as being strong or weak, but we would say the yen is strengthening. If the yen is able to buy more dollars now than it was last year, or if the dollar is able to buy fewer yen now than it was last year. We could also describe this concept as appreciation of the currency. So if it was 105 yen to the dollar last year and 102 this year, the yen has appreciated. The opposite would be if it's 105 next year and 102 this year, that would mean that the yen is depreciating. And all of this appreciation and depreciation and strengthening and weakening, it occurs over time, and it's between two countries with their currencies relative to one another. Now, we said we'd introduce a concept of a real exchange rate, something that's corrected for inflation and corrected for prices. The real exchange rate should be the rate at which goods and services in one country could be exchanged for goods and services in another, not the rate at which money could be exchanged for money, which is the nominal exchange rate. But note, if you want to buy things in the United States, you need to buy them with dollars. If you want to buy things in Japan, you need to buy them with yen. So the actual nominal exchange rate is important, and it does play a role. That nominal exchange rate, that's E in our real exchange rate calculation. And then E, the nominal exchange rate, is multiplied by a price ratio, multiplied by P, the domestic price, divided by P star, the foreign price. Here's an example. I want to use one good so we can easily define what the price is. And this one good will be a Big Mac. Obviously, a McDonald's Big Mac sandwich is the same whether it's produced in the United States or Japan. So we don't need to think about product quality. Suppose in the United States that Big Mac costs $2.50. Suppose in Japan that Big Mac costs 400 yen. Also suppose that the nominal exchange rate is 120 yen per US dollar. So you could go to any exchange booth, give them $1 and get 120 yen. Now, E times P, that would be the price of a US Big Mac as measured in yen. So to get that Big Mac, you need $2.50. In order to get that Big Mac with yen, you need to exchange enough yen to get $2.50. That cost of a US Big Mac as measured in yen would be 300 yen. Now, the cost of a Big Mac in Japan, where you would naturally pay in yen, we said was 400. So now E times P over P starred, the real exchange rate, would be 0.75. Here we can exchange 0.75 Japanese Big Macs for 1 US Big Mac. This is an exchange of goods for goods. It's a ratio of goods, not money. So it's a real rather than a nominal exchange rate. That Big Mac example may seem relatively strange, relatively arbitrary. That funny Big Mac example is actually used to calculate indices for real exchange rates to try to determine which exchange rate is over or undervalued in the long run by the newspaper The Economist. We could also compute a real exchange rate using another example between Mexico and the United States by comparing the price of Starbucks lattes in Mexico or the United States. Suppose the nominal exchange rate between the United States dollar and the Mexican peso is that you can buy 10 Mexican pesos with 1 US dollar. Suppose if you buy a Starbucks latte in the United States, it costs $3. Suppose if you buy a Starbucks latte in Mexico, it costs 24 pesos. And look at what the price of that US latte is for someone in Mexico who would want to exchange pesos for dollars in order to buy it. The price of the US latte as measured in pesos would be $3 times 10, since they would need to exchange 10 pesos for each of those dollars. They would need to exchange 30 pesos to get $3, which they could use to buy 1 US latte. Now, the price of that latte in Mexico in actual pesos was 24. So that real exchange rate would be 30 over 24, or 1.25. Now, if we're looking at economies with many rather than one goods, we're not going to look at lattes, we're not going to look at Big Macs, since the prices of Big Macs and lattes may not be representative. What we would use is then a price level, and how that price level changes over time, both in the United States and other countries. And here this P, as used in our calculation of a real exchange rate, will be a CPI, rather than a price of a single good. And our foreign price level will now be a foreign CPI, P star. Now, what we'll now be looking at is the relative price of our domestic basket of goods as compared to a foreign basket of goods, looking at that basket which is used to calculate the CPI in both countries. And then if the US real exchange rate appreciates, that would mean that US goods in general, all of them, not just Big Macs, were becoming more expensive relative to foreign goods. But our calculation, our formula, would remain the same as in the Big Mac example or the latte example. Simply E, the nominal exchange rate, times P, the price of a domestic basket, divided by P star, the price of a foreign basket. Now, when we're talking about how these exchange rates should be determined, at least in the long run, one concept that macroeconomists introduce is something they call the law of one price. And that means that if we have a good that can easily and costlessly be moved from country to country, put on a ship, transported at low cost, it should have, unless we have other barriers to trade, the same cost everywhere. Tradable goods should have the same price everywhere, otherwise there would be an incentive for people to engage in arbitrage. That is, making some profit simply by taking a good where it's sold cheaply and moving it to a place where it can be sold at a higher price. If in our example, Big Macs were selling for 4 in Japan, but only 3 in the United States, then in the United States we could buy a cheap Big Mac, put it on a boat, ship it to Japan, and sell it for a higher price. Of course, Big Macs won't keep that long, so we're not going to have arbitrage in the Big Mac market, leading to just one price in the Big Mac market, and we wouldn't necessarily expect this law of one price to hold true for products like that. On the other hand, when we're talking about a product like, say, oil, we can much more easily buy oil in a place where it is cheap, put it on a boat, send it to a place where oil is expensive, and profit from that arbitrage. So in the case of oil, we have world prices all around that are much closer to being the same than we would expect in goods that are difficult or impossible to transport. Things like taxi rides, haircuts that can't be moved across borders at all. This law of one price leads us to another theory or a model that we call purchasing power parity. This theory is that exchange rates, those nominal ones, they should adjust so that the same unit of currency would be able to buy the same amount of stuff everywhere in the world. That is to say, if we have $1, then exchange rates should adjust if price ratios are fixed, relative prices in different countries are fixed, and relative prices in these countries will be fixed due to arbitrage. Then we should be able to buy the same amount of stuff by going to any country, exchanging our dollars for local currency, and buying things in that country as we would have been able to buy in the United States with those dollars. That's the idea of purchasing power parity, determining nominal exchange rates. The nominal exchange rate should adjust over time so that the value of a currency, the amount of currency can buy, is the same everywhere in the world. Because the real price or relative price of all of those goods in different countries would be the same. Now, in our Big Mac example, we said that the real exchange rate was not 1. So $1 would be able to buy more in the United States than it could buy in Japan. Or 1 yen could buy more in the United States than it could buy in Japan. So our theory of purchasing power parity would suggest that over time, E should adjust in order to keep that E is the nominal exchange rate, in order to keep that real exchange rate constant, or that real exchange rate equal to 1. So that the price of that Big Mac was the same in both countries, as expressed in either dollars or expressed in yen. So then we, using that model of purchasing power parity, since we know P and we know P star, we could solve for what E needs to be, which is equal to P star or P in the long run to give us a real exchange rate of 1 and purchasing power parity. Now, what PPP also implies is that nominal exchange rates will adjust over time as prices adjust in those two countries. If we see P star increase while P does not, then E should increase along with it. The nominal exchange rate should increase along with it, so that it's the case that even though goods in, say, Mexico have become more expensive, the US dollar is able to buy the same number of Mexican goods as it would before. So the number of Mexican pesos that a single dollar can be exchanged for, E, has to rise along with Mexican prices, or has to rise along with the rate at which Mexican prices diverge from American prices, or the gap in inflation rates between those two countries. What this means is that countries where inflation is high, typically, based on this theory of purchasing power parity, should be expected to see depreciating currencies over time. Countries where inflation rates are low relative to other countries should expect to see appreciating currencies, appreciating exchange rates over time. So if in Turkey we have an average inflation rate of about 10% over several years, and in the United States we have an inflation rate of average 2 or 3% over several years, we should expect a tendency, not because of anything directly influenced by policy, not because of the central bank or anything like this, we should expect a trend due to the theory of purchasing power parity, that so an American dollar can buy the same amount of Turkish stuff, even though Turkish stuff is becoming more expensive, then an American dollar would be able to be exchanged every year for a larger number of Turkish lira. We'd see appreciation of the dollar relative to the Turkish lira, depreciation of the Turkish lira relative to the dollar, caused, in fact, by differences in the inflation rate. Of course, we can also see, because many goods are imported, that as the currency depreciates, the price of those imported goods rises, and we can have a movement, an effect in the other direction as well, that inflation could also be caused by depreciation in the exchange rate. Now, as we mentioned, PPP isn't a perfect method or perfect model to explain how exchange rates should change over time or what the true correct exchange rate should be, because of course many goods can't easily be traded. Many goods can't easily be traded, like haircuts, because they're necessarily going to be produced in the same place and at the same time as they're consumed. So there's no reason to expect that the price of haircuts would be the same in all countries. And there's no reason to expect that the cost of a basket of goods would be the same in all countries, given that the basket of goods would include some non-tradable goods. But specifically, if we look at tradable goods, we make a basket of tradable goods alone, we could get useful insights nonetheless from that PPP model as to what exchange rates should be. Therefore, we would be likely to expect in the future, if in the short run they deviate from a true value. It may also be the case that foreign and domestic goods aren't exactly the same thing. So Japanese cars and American cars aren't exactly the same thing. And if they're not exactly the same thing, also there's no logical reason to expect that they ought to have the same price. And it's the case that there may be other factors influencing the cost of production in an economy that make it simply more expensive to produce a good in one country than it is in another. And those goods may have higher prices in countries where they are more expensive to produce than they are in other countries. If productivity, for example, is low, businesses are not well organized, there's too much of a regulatory burden, or anything else that causes those prices to be high. Nonetheless, this PPP model does do a good job of explaining long-run trends and tendencies in exchange rates and can be used to predict some of these long-run movements, to predict which currencies appear overvalued, therefore should be expected to depreciate, or which currencies we see as undervalued and might be expected to appreciate, or which currencies we would expect to have a long-run downward or upward trajectory relative to one another. Data can be gathered that supports some of those conclusions that are drawn from this purchasing power parity model.